My next guest says commercial property risks are also rising in states like California and Florida. It impacts where he chooses to deploy capital. Joining me for an exclusive interview is Joey Agree. He's the CEO of Agree Realty. They lease retail properties across all 50 states. Welcome to you.
Thanks for having me.
Is this becoming a rising cost burden, insurance and so forth?
It has. I mean, as you mentioned, we have properties across all 50 states. Properties that are based in CAT zones, whether it was hurricane zones or now the fire zones today, have to be a critical aspect of where we invest capital. Now, we're the beneficiary of having 2,400 properties across all 50 states, a large blanket policy to cover it. Unfortunately, the smaller investors today, it's even a bigger, right? Yeah. It's even a bigger hurdle for them to decide where to deploy capital.
Because I'm thinking, okay, well, I mean, a fundamental part of real estate is you build it where the people are, right? So your shopping centers, you want to build it where the population is. And if the population is in a high wildfire risk zone, well, someone's going to still go build that strip center.
Well, they have to build the strip center, they have to finance the strip center, and they have to insure the strip center at the end of the day. And so larger landlords like ourselves have the ability, again, to have blanket policies, higher deductibles that typically get passed through to larger retailers that can self-insure or, again, have blanket policies. It's really the small business owner, whether it's a retail or a landlord today, that's going to feel the true pain here and the inflationary pressures that are to come.
I also was looking at your store mix, and it's a lot of the real stalwart names in U.S. retail. It's Walmart, it's TJ Maxx, is that right?
Correct. The biggest and the best retailers in the country.
Right. So we're in a moment now where we're starting to see choppier results. Of Signet this morning was one example. Abercrombie, Nike shares are at, another 52-week low. So how do you kind of know that you're betting on tenants who are going to be the ones with staying power versus the ones whose performance might be a little less reliable?
So it's really a 30,000-foot lens. We invest in recession-resistant and then omni-channel critical retailers today and the largest non-discretionary operators in those respective sectors. So as you mentioned, Walmart, TJ Maxx, O'Reilly, AutoZone, the retailers with core durable brick and mortar and services today that consumers are going to need regardless of the macroeconomic environment. Our focus is on those largest retailers that are continuing to take share in an omni-channel world today, in a post-COVID world where the acceleration of that multi-level deployment, a multi-mode deployment to consumers just continues to accelerate.
Remember the death of the shopping mall? I mean, this.
Oh, I remember
How many narratives have been hanging over here? There was the death of the shopping mall. There's the commercial real estate cliff. Maybe that one's still more relevant.
And today we see the exact opposite. Today it's really back to the store. Retailers such as Walmart and TJ Maxx and AutoZone spent, let's call it a decade approximately, of investing in e-commerce fulfillment, their distribution centers, all of the different modalities, again, to bring customers to the store and to bring goods to their homes. Today, we see them really recalibrating, bringing the store, becoming the hub of the overall omni-channel experience, forcing customers to come to the store through discounts, through coupons, encouraging customers to return to the store, because at the end of the day, free shipping and free returns, it doesn't work for the bottom line of retail.